Crypto is the only market where all data is transparent. Most other markets are opaque. In most other markets, we don't know what the whales are doing. We don't know what the long-term holders are doing. But in crypto, the people that dive into the data have an edge versus the rest. And because of that, we are going to do exactly that in this video. Now have a look at this. This is the unrealized profit and loss for Bitcoin. So in black, we see the Bitcoin price, and the unrealized profit is in green. And no surprise, from the cycle top in 2021 to today, where the price also almost 2x'd, the unrealized profit also almost 2x. However, there is something very interesting when we look at the realized profit, because the realized profit did not grow that much. Have a look at this chart. So this shows us now with this green area when people are moving their Bitcoin when they are in profit. And measured in US dollars, this did not double. Now this explains why over the long term, the Bitcoin price rises. There is still adoption of long-term investors. So people that buy Bitcoin on average just hold through the cycles. Yes, there is sometimes portfolio rebalancing happening, but maybe the people that start off with 5% then see Bitcoin growing by 2, 3, 4, 5x. They might then rebalance their portfolio and keep maybe 10%. They don't go back down to 5%. So most people that start to make money in crypto, most people that see green numbers on their screen, they feel reassured to stay in the asset. Because this is how it usually works, right? There's some tangible interest in Bitcoin. Most people just play around with small allocations, and then over time, the volatility becomes normal. The ups and downs don't bother that much anymore, and people learn more and more about the asset. And it tends to be the case that the more is learned, the larger the allocation in the portfolio in the end ends up being. Now let's first focus on the losses. Over the cycles, the drawdowns tend to slow down. So the bear markets aren't that brutal anymore. The growth, of course, also isn't as quick as it used to be. But while in 2015, it was still possible to have 87% of unrealized loss, that went down to 75% in 2018 and to 60% in 2022. So the worst case of a bear market for unrealized peak loss is probably now below 60%. Maybe it's going to be 50%, maybe even less than that. We could draw an imaginary line over here. And so we have almost a quantifiable way to show that Bitcoin becomes less risky over time. Now let's switch to the unrealized profit. Over here, interestingly enough, it seems to not go down that much. Yes, we were at 84% in the past, then we peaked at 76%, but then the subsequent peak of the bull market was 74%. This would indicate that maybe we've got much more way to go. Maybe an unrealized profit of 70% in the cycle peak is possible. Now, there are different lenses to look at very similar data, right? We looked at the unrealized and the realized profit and loss in US dollars. We also looked at this in percentage terms. So when we buy, how much percent are we in profit and losses? But we can also look at this in terms of Bitcoin. So the market as a whole measured in Bitcoin. How much is it in losses or how much is it in profit? And can we potentially derive some cycle bottoms and peaks from that? So let's look at the realized profit and loss. Let's first start with the losses. What does it mean when there's a lot of realized losses measured in Bitcoin? It means that people are giving up. It means that people capitulate. And interestingly enough, those kinds of capitulation events had been incredibly good buying opportunities. We want to buy when people don't believe in Bitcoin anymore. Now, unfortunately, we don't see this too often. And especially after the collapse of Terra Luna and FTX, we haven't really seen any event that would spook the market as a whole. But it's good to keep this in mind, right? When there's a lot of people that sell Bitcoin at losses, that's a potential turnaround. Now, interestingly enough, we see something similar for the profit taking. When a lot of people take profit, the market tends to be close to the top. Now here's my explanation. When Bitcoin moves from a long-term holder to a new investor, then the reference price in the market changes. So when people are currently massively in profit, they send the Bitcoin over to a new investor. That new investor now expects further rising prices. If that does not instantly happen, the prior rally suddenly stops, then those new investors might sell very quickly. They're not as much of diamond hands compared to the long-term holders that bought before. Now, the exact opposite argument can be made for the losses, right? When people give up on Bitcoin and they sell and new people enter the space, then it's okay if there's a bit more volatility, right? The people that buy at the bottom of the bear market, they don't necessarily expect that the price instantly turns around. They can potentially digest a bit more of a downturn. So the people that buy at the end of a bear market tend to be long-term holders. They might dollar cost average in. The people that buy at the end of a bull market, they tend to be the short-term tourists that maybe have heard about Bitcoin just in the news and that don't know much about the asset. And so really it doesn't matter who is realizing the profit or the loss. Whenever this is peaking, we tend to turn around in the market. When the losses are peaking, we tend to be at the bottom of a bear market. When the gains are peaking, we tend to be at the top of a bull market. Instead of overlaying those graphs on the same scale, we can also swap this to the positive for realized profit and to the negative for realized loss. And we can also calculate the delta. That's then this line. Again, this is measured in Bitcoin. And again, we want to rather sell when this is high. We want to rather buy when this is low. And currently the market is kind of in equilibrium. We are not at an extreme value in any way. Now let's calculate the ratio of the unrealized profit versus loss. That's this chart over here. Isn't that interesting how this tends to peak at similar levels? Again, of course, we want to buy whenever we are below the 1 mark and we want to sell whenever we are above, at least when we are at peak values above. Now, many ways lead to Rome. There are a lot of different ways to beat the market. We can just ride the macro. We can buy when everybody gives up on Bitcoin, or we can be a bit more active. The market is inefficient, and so if we do active altcoin trading, if for example we bet on falling prices of very poorly performing altcoins, we can make money as well. But since this is a video on the macro, have a look at this. This is the percent of unrealized profit. So how many Bitcoin is currently in the negatives? And interestingly enough, this tends to bottom very close to 40% every single time. It was after the Mt. Gox and Silk Road collapse. It was after the ICO bust and miner collapse. And it was also after FTX and Three Arrows Capital and Terra Luna went belly up. So there's always a story to those bear markets. There's always something that causes them. And there are very few eyeballs on crypto during times like this. Nobody wants to know about crypto. Nobody Googles about Bitcoin. Everybody is looking away because it's just so painful to look at those red negative numbers. It's very scary also to buy. Everybody says that Bitcoin is going to zero, that it's all a scam. And that's the point in time to buy in heavily. Unfortunately, this doesn't happen too often, only every 3 to 4 years. Maybe next year we see another crash. Who knows if the same rhythm will prevail. What's also interesting that the entire market's unrealized profit is very closely mirrored to the long-term holder unrealized profit. So in the end, it's really the long-term holders that make the cycles. When they take profit, we should take profit as well. When they are in losses and potentially buy more, we should buy as well. Now, the vast majority of people in crypto approach the market in the wrong way. Most people try to find those multiple X returns. They try to find the few assets that make outsized win. But this is clearly a game against the odds. Most altcoins tend to go down massively. A 70% decline over here, another 80% over here. It's all double-digit losses. Now, the common counter argument is that maybe we don't just buy 1 or 2 altcoins, maybe we buy multiple and then we might get that high flyer as well. But the problem is that diversification, so spreading the risk across various assets, does not work with altcoins. Everybody can launch an altcoin. Everybody can increase the supply as they want. And so in aggregate, the altcoins tend to do worse compared to Bitcoin and Ethereum over the long term. What we've got over here is the others dominance. So how much of all of crypto is in the altcoins that are not in the top 10? And 3.5 years ago, this was still at 19%. Now it's below 8%. So had you invested in a broadly diversified basket of altcoins, you would have on average underperformed the market by 60%. 15%. Instead of trying to find the needle in the haystack and most likely lose, at least in the long term, isn't it better to try to get the odds in our favor? If most things don't perform that well compared to Bitcoin and Ethereum, if a lot of altcoins inflate in supply over time, so supply grows faster than the demand, then why don't we bet on relative valuations? It's a bit more complex of a game, but I believe that this added complexity does help. We want to make our investing as simple as possible, but not simpler than that. And so here I am doing something differently to most other YouTubers. Most crypto YouTubers, they just show one single win. They say, here, I made some money over there. Just trust me, bro. Very few are willing to share their trading history. Now, here's my trading history on Hyperliquid. This is where I started trading decentralized perpetual futures. This is the profit and loss. And the maximum drawdown was only 5.1%. Now, obviously, I'm not going to share my positions open here on YouTube. That's part of the premium membership. It's down below. It's thebitcoinstrader.com. Now, the issue with trying to pick the winners is, of course, that we have a very low chance of succeeding. But the beauty of crypto is that it's still an incredibly inefficient market. People always say that capital markets are efficient, but in the end, it's the people that make it efficient. So if you know more than the average market participant, if you do more research than most people, if you're part of a group of people that do more research than the average market participant, then we can win. Then we are the people that make the market efficient, then we are the ones that make the profit. For example, this here. This is pure inefficiency. This chart shows the balancer token relative to Ethereum. A very constant underperformance. And we can make money from that underperformance. As the price is going down, we are printing money. Yes, we are betting on falling prices. And yes, this might be a bit more scary at first if you don't know what you're doing, if you haven't yet learned about this whole topic. But the risk is every now and then a potential short-term pump, again, when we bet on falling prices. But the reward is a very long-term constant trend. We can also turn this chart around. So this is now Ethereum relative to balancer. So basically buying this when we long one asset and short the other. So the inefficiencies are not necessarily that obvious in the macro, as in the market is expanding and contracting in a way that's not that predictable. But the relative valuations are much more predictable. The risk to reward in a chart like this is quite obvious, isn't it? People make all kinds of mistakes. People, for example, also just leave their stable coins in their wallet, right? Let's say you trade actively, you've got some stable coins and you don't use this for anything to add some additional return. That's also a mistake. For example, here we can get 15% APR by providing liquidity to Hyperliquid, the largest decentralized perpetual futures exchange. It's comparatively safe. It's definitely worth the risk for 15% APY. And so this is then the feedback that I get in the chats. It was the first nice trade. Thanks, Gerhard. And over here, a few more positive trades, etc. And people make their money back very quickly. Premium has already paid for itself. And yes, if you've only got a few $100s in crypto, this is probably not worth it. But if you're investing several thousands of dollars and you're still inefficient in your trading, if you still hope for your one altcoin to outperform, it probably makes sense to learn a bit more. And this is what I mean by learning. I've published more than 100 tutorial videos on various topics within crypto, on how to use relative valuation bets, on how to manage risk, on how to do on-chain analytics. Feel free to binge watch all of this. And of course, I'm also sharing my own trade. So for example, here is a trade opened on the 30th of April. And here's then how I closed this 5 days later. Yes, this is only a single example, but that's why I showed the overall portfolio chart before, right? This one over here. And so feel free to check it out. It's currently $125 per month. It used to be $165 when everybody was super hyped about crypto. Currently, the attention on crypto is rather low, and so the price is also lower. If you lock in that price now, you will not be affected by the price increase that might happen once the market picks up again. So everybody that signs up locks in their current rate. If it's your first time here, feel free to subscribe. I publish here regularly. Like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. There should be somewhere a card over here. You can just click on that and it will lead you directly to the sign up page. So see you over there as well. Cheers.